We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
It's a brand new year for your money. Are we expecting a recession? What could happen? And where is your money going? Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and we are here for our Wallet Watch segment with Chris Calandra of Elliott Wealth Management. Chris, welcome and Happy New Year.
Happy New Year, Eric. Happy to be joining you today.
It's always great to have you. And as I said in the intro, we've got a lot of recession predictions going on out there. Some say it's going to be minor, some say we may avoid it, and some say we're in for the mother of all recessions. So what do you see coming down the pipe?
Well, my opinion is a bit more optimistic. I agree with your original premise. There is a ton of negativity out there, and you see this with your everyday American you come across on the street. When I look at the economists and financial folks that I tend to read, follow, listen to, there is a lot of negativity, very sour mood out there. I am a bit more optimistic because I am of the opinion that inflation will come down faster than expected. And if that happens, the Fed can be less aggressive, not have to go as far and as fast with their interest rate increases, which means that we might be able to avoid a recession, or more likely, I'm in the camp that we have a recession as expected, but it's pretty shallow and pretty brief. That would be my best guess.
Great. Now, you mentioned there's all this negativity out there, and we have talked on our sister podcast, Carnivore Bites, which of course you were part of Carnivore Radio for a long time, how a big part of recessions is the mental attitude. If people expect a recession, they're going to get a recession. So how much of what we're seeing is because people do have, consumer confidence has been down. Even as inflation slowed down, it was still ridiculously high, especially on food, which is what people see the most often. So how much of the potential of a recession right now is that negativity, and how much is actual data?
Yeah, it's a great question. The self-fulfilling prophecy element to this is pretty powerful. If people are expecting something, they're likely to get it. And the expectations are for a recession, and that does increase the likelihood that we get it. Consumers have been hit very hard. This inflation story, as I've been saying for a long time now, is not something that people need to be have explained to them. They don't need to watch TV to figure it out. They see it when they go to the grocery store, when they go out to eat, when they fill up their tank, although that's improved a lot lately, when they get their utility bills. Seemingly everything that they spend money on every day has gone up dramatically. So even though the inflation pressures have eased a bit, it's not really noticeable, and people are still kind of in a foul mood about it, and are still have angst about it. And if they change their behavior because of inflation and the higher prices and the expectations for more of that, that could have a very negative impact. To this point, though, Eric, when you look at consumer spending, it is very strong. Consumers are out there in force. Now, some of that's being fueled by borrowing, because when you look at the borrowing numbers like credit cards and that kind of thing, it is spiked. So it may not be sustainable, but I joke about this You go to a nice restaurant and you eavesdrop on, let's say, 3 couples at the next table. They're ordering a beautiful bottle of wine. They're ordering appetizers, steaks, dessert, running up a big tab. And you listen to them and they're complaining about inflation.
All right. People's behaviors don't necessarily follow what they're feeling, but we have already seen some behavioral trends, especially in driving, because the cost of gas went up. And again, as we've talked about on our sister podcast, Carnivore Bites, what we've seen in the past is that the cure for high fuel prices is high fuel prices, because people stop driving, they bring down demand, and that brings down the price. And we've seen that happen. Unfortunately, you can't necessarily eat less. I mean, you can to a certain point if you're watching your weight, but there's only a certain amount that you can cut out before it's too painful. So we are seeing that behavior. And something else that we're seeing behaviorally, as we were talking about before we started recording, we had a jobs report come out last week that showed the participation rate starting to tick up, but only mildly. We still have a lot of people out there who are unemployed, not looking for jobs, and they're basically living on the money that the government has been sending out. And for our listeners around the country that are saying, well, I haven't gotten a stimulus payment in over a year. Some states have been supplementing that. California has been sending out stimulus payments, a number of other states. So in very high population, very blue states, the government is still giving away money to keep people out of the workforce.
That's right. And the Biden administration, the federal government, continues to spend money to try and stimulate and put money in play, which this isn't a political show, but seems to me to be a very dangerous thing that is being done. Not just the spending. I mean, it's more the scope and the depth of this is very alarming. But you are right about when you went into this inflation period, your average American, and I'm talking stereotyping, broad, not every household kind of thing, because of the stimulus and the aid and the slowdown in spending during the pandemic, they had some reserves more than they usually have. And those reserves, by and large, have gone away. Some states are trying to supplement and replace that stimulus and help. But that does, it seemed to me, explain why you're seeing the spikes in spending. The consumer went through their reserve, their extra reserve, spent that down, and now has chosen to do some borrowing as opposed to changing their behavior. And that probably can't last. So either things are going to have to get better in some way or multiple ways, or they will have to change their behavior, because you can't just borrow perpetually. The American consumer can't. Perhaps the government can. So that's really the play. That's really the play. I am always cautious, Eric, when people talk about the consumer's going to stop spending and that's going to cause problems. The American consumer doesn't stop spending. So I want to be careful about that. You might see changes, but it would have to really be a shock like the pandemic was, where you really see Americans, I think, change their behavior notably. And if you believe in that, then you start going into the camp of a deeper recession and or the mother of all recessions. But as I already stated, I'm not really in that camp.
Yeah, you bring up a good point. The American consumer is a spending consumer. They want to spend, they have that desire. And there's also another factor, because spending had dropped so much during the pandemic, you're now seeing necessary spending on appliances that have broken down and need to be replaced. We did see a lot of home repair done during the pandemic, but you're seeing now things need to be replaced, and that's also boosted, what I refer to as necessary spending, because you don't have a choice when your car breaks down and it has to be fixed or it has to be replaced for you to get to work. You don't really have a choice in that spending.
That's right.
So before we go, I want to get your opinion on what we're going to see from the markets this year. 2022 was a rough year for the stock market. Are we going to see the same type of volatility that we've been seeing? Do you think things may calm down? What's your best guess?
Yes. So I would say expectation would be for continued excess volatility. Because there's so many cross currents. This includes the war in Europe, which we haven't talked about. There's a lot at play. So I would expect a lot of volatility. Going back to what I said earlier, my baseline thesis is inflation will come down faster than most Americans, most people are thinking. And if that is the case, that means the Fed could calm down on its aggressiveness. That means I think the economy could perform a little better. So all this to say, I think that the market can enjoy a rebound this year, perhaps not ripping off some astronomical returns. But I feel as though my best guess is that the market bottomed in September and that we're in the early stages of a recovery, despite all of the bad news, all of the negativity, all of the worrisome aspects. If we could just come in a little better than expected on one or more of these fronts, not necessarily really good news, but maybe a little bit better than expected bad news, I think that the market could have a nice recovery. I would not, of course, I'm not giving anybody individual advice or anything, but I'm cautiously optimistic that this year will be a recovery year, again, based on inflation being tamed a little quicker or starting to be tamed quicker than a lot of people are anticipating.
Excellent. Thanks for being here. That's the Raw Naked Truth. And of course, always remember, before making any financial decision, check with your individual advisor, because everybody's situation is different. That's the Raw Naked Truth. You can catch every episode of the Raw Naked Truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Audible, Amazon Music, and other platforms that respect freedom of speech. We'll see you next time.